Hey traders, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Tuesday, December 22, 2020. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. What do we have on the docket today? Well, the first thing we're going to do is take a look at the daily chart as we always do. What's jumping off the page? Has anything significantly changed from the previous day or days? What's really the chart telling us? Well, based on today's activity, which was minimal at best, it was a very narrow range, meaning the high of today and the low of today were pretty much contained in a narrow range, aka not far apart. The market did not close above yesterday's close. Is that important or significant? Well, it's something, but we don't know that it's important or not important. It's just something to talk about. They didn't close above yesterday's close. That would have been more bullish than not closing above it. However, not doing it doesn't mean they can't or won't do it the following day, tomorrow. But what they did do is basically continue to stay above the 20-period moving average. I think that's something else that the bulls can continue to hang their hat on. As long as they're above all the moving averages, the market is undeniably in an uptrend. The trend is your friend until it's over. Above all moving averages, she's all right. As far as the daily chart is concerned, that's really all we have. The market was rather quiet today, and one of the reasons for that is we're in the midst of a holiday week. It's Christmas week, and with that being said, let me wish everybody that celebrates it accordingly a Merry Christmas. A few days in advance, but nevertheless, I hope everybody enjoys the holiday season. That brings us to another point, which is what's the schedule for this week? So the market is open for full days Monday, Tuesday, and Wednesday. Thursday is scheduled for a half day where the market closes at 1 p.m. There's generally speaking not a lot going to go on that day. It remains to be seen whether or not we'll actually have inside the numbers on that day. I'll let members know the night before what the intentions are. Of course, Friday the market will be closed for the Christmas holiday, and then we'll resume regular trading the following Monday. The following Thursday of next week is Christmas Eve. The point here is that this span of time between now and Christmas Day, the market is traditionally rather quiet. Anything can happen. We've seen sell-offs before. We've seen rallies before. But the norm, using the 80-20 rule, the majority of the time, the market's going to be contained. The volume is going to be very, very light. There's not going to be any large moves in any one direction or another. Maybe one day here, one day there. But in large part, for this span of couple of weeks, a lot of traders, a lot of investors, a lot of institutional money managers go on vacation. Even if they're not physically going anywhere as they normally would based on the whole coronavirus situation, there's still a lot of people that are going to take some time off. It's been a wild year, and time off is well-deserved. It becomes a self-fulfilling prophecy. If everybody believes that the volume and the trading is going to be very, very light, the price action very, very quiet, then it becomes a self-fulfilling prophecy because a lot of people will shy away knowing that a lot of participants are just not in the market. Let's get to inside the numbers and we'll discuss today's intraday activity. Albeit very light, there was still opportunity on the board. We'll talk about stocks on the move second. We did have two stocks that hit their price objectives. We'll come back to that after. The pre-market commentary was simple. It's turnaround Tuesday. We're waking up mainly flat. After yesterday's wild ride, that's more bullish than bearish. That's what the face was early in the morning, about 6:30 a.m. Eastern Standard Time. So as the morning gone on, they actually got a little bit stronger before they got weaker. So they were creeping up to the big fat round number of 3,700. That appeared to be the objective. That's the ES. The corresponding SPY number is not necessarily 370. There is a spread between the two. That's a story of a different ilk. And here we go again with the holiday shortened week. Again, I'm just informing inside the numbers members of things that we need to think about in the pre-market as we come for game time prepared. We need to know all the angles that are on the board. Lesser number of participants, the volume and volatility will typically get lighter and lighter as the week goes on. They, the bears, had a chance yesterday to really kill the market, but they couldn't get the job done. The trend is the dominant overriding thing. We've talked about that here many, many times, just to reiterate it again, and also take notice of what really did happen yesterday. Early in the morning, they could have driven the market a lot lower. They didn't or couldn't do it. That is, on its face, telling you that the major force behind the market is something other than what was in the media and on traders' minds first thing in the morning, but the more dominant force is something larger. I'm calling it the trend. If you want to have it be something else, that's your prerogative. Moving right along. Now check this out. This was still early, 7:55, but I take notice of things as the day goes on. Thought I'd pass along some information. Remember yesterday we had a target of 369, and you'll also see that come out later on inside the numbers. But what was happening in the pre-market is they were already doing the thing that I expected them to do if they could rally yesterday afternoon. They ended up doing it pretty much in the pre-market today. Here's a picture of the 24-hour activity, or including the pre-market, I should say, of the SPY. And these funny color ones are early this morning. So this is 7:30 a.m., 7:45, and here's the high of the morning at 8:30 a.m. The high was 368.96. That was, in fact, the high of day. They never got higher or even back to that price in the regular pit session or from 9:30 forward. Tells me a couple of things. A, that number was important. B, they could have got to the fat round number of 369 if they wanted to. They came up short. Is that the market's way of trying to indicate something? Is that the market's way of trying to say, hey, look at this. I can't even get to a number that I should be able to get to and actually through, and here's a sign or potential signal that the market is actually showing some weakness. Now, some of that is Monday morning quarterback stuff, but it's a way that we incorporate things that happen and also things that don't happen into the conversation. Let's move along, see what else we have. 8:50, we're getting closer to the opening bell. Up north, we know either they open above 368.85, that would really put the market in the most bullish position it can be, or they don't. If they don't, we'll consider it overhead resistance and the bulls will be trying to bust through. What about down south? Well, we have the gap left open from Monday's close at SPY 367.95. It's important, and if they start getting below and close candles below, we're talking 366.60 again. Remember that one from late yesterday. Now, let me reiterate this. 366.60, you're going to see it again on the board later on. Write that one down, put it on a sticky note. Just remember it. Let's see what else we have as the bell gets underway or the day gets underway. Continuing to trade below the gap, 367.95 leaves the door open for 366.60 still. If they can get back above the gap and close candles up there, the door opens for 369 for starters. Bull-bear battle still going on. For learning purposes, if you watched price at the end of the first 15-minute candle, toward the close of the candle, they fought back to get the gap at 367.95. They didn't do it, or they couldn't do it, I should have said, but it tells us for now that that price is important. So by 9:45, we have the makings of a pivot on our hands. Now, you know the routine. Right of the vertical on this 5-minute SPY chart is today's activity. Where you see the line at 367.95, you can see where the market knew and was attracted to pretty much all day long, minus one little dip to where? 366.60, slightly below, but that was an important spot, and they came out of there pretty quickly, telling us once again they were running a test. We're going to look at some other charts, and I'm going to talk about that a little bit further when we look at the longer term charts. Hard to see what I'm thinking about on a 5-minute chart. It's actually hard to see what I'm thinking about anyway. While I'm at it, you wouldn't believe some of the things that I'm thinking about, by the way. Back to the point. We know that 367.95 was important all day long. There's no two ways about it. When they can't sustain price above, they fall away. They did it twice. Now, we picked up on that number 15 minutes or within 15 minutes of the trading day. How you doing? It pays to know your numbers. So as the day goes on, you'll see a lot of the same thing. You'll see 366.60 mentioned, that if in fact they can't get through one, they're going to fall back to the other. Can't get above 367.95, opens the door for 366.60. Doesn't mean they stop on a dime, but it opens the door for 366.60. 10:01. Technically, the door is open for what? Yeah, 366.60. Closing candles above 367.95 opens the door for 369. That was basically the theme of the day. 10:25. You want to know if 367.95 is important? Watch price action around the number at the end of the hour, 10:30 a.m. Eastern Standard Time. Okay, let's do that. Let's take a peek. So where are we? Here's 10:25, and as we approach 10:30, what do? They run right up to the number, close 367.97, giving you the impression that they're going to continue higher until about 15-20 minutes later, they decide to fail. What happens if they decide to fail or actually do fail? What does it open the door to? Yeah, let's say it all together, 366.60. Let's move along a little more, see what else we have. 10:30, the hour closed. We already talked about that one. 38, the schematic says since they closed above 367.95, the door opens for 369, give or take. At present, they're working on the schematic. They started to push higher, but they failed. How about another little teachable moment / learnable opportunity? So here's that 5-minute chart again, and I always say all charts act and react the same way. So let's just look at it this way. Look at it from this perspective. The first 5-minute candle of the day was what? It was a big breakdown candle. Okay, what do markets like to do? They like to get to or run a test of the high of the breakdown candles. Okay, fair enough. What did they do? After the market came down, they tried to run a test of the high of the breakdown candle. They didn't quite get there. They tried it again. They didn't quite get there. They tried it again. They actually got above the high of the breakdown candle, but they didn't close a 5-minute candle above the high of the breakdown candle. What happened? The market fell away. Now, I'm not suggesting that in and of itself is the reason the market fell away, but these are all the pieces to the puzzle that happen one thing at a time, that when you begin to assemble the puzzle, you get the picture of what's going on. Small time frames morph into bigger time frames morph into bigger time frames, and so on. Let's see what else we have. Moving right along. Oh, what do you know? Below the gap, 367.95, the door remains open for 366.60, above, blah, blah, blah. Now, here's where it starts to get interesting as the day goes on. The hourly chart is making a bullish flaggish pattern, back and forth until it's ready to go higher or they break the pattern. Another test, they had one late yesterday, of 366.60 doesn't change that. Now think about this. This was at 11:02. It doesn't change the bullish flaggish pattern. Closing hourly below does. You've got the current schematic back after lunch. Now we're moving along still. Now think about this. That was right about 11 o'clock. Now the next post is at 11:47. Let's look at what happened in between. Now we're looking at a 15-minute chart. And what happens is, after I make the post, I'm taking a break. I walk away from the screens. As soon as I walk away from the screens, things change. That doesn't happen often, it doesn't happen a lot, but it does happen from time to time. That's why I lay out the schematic as a just-in-caser. You have to be prepared before the game, you have to be prepared for the game, you have to stay prepared during the game. So here we go. So here is 10:45, 11 o'clock, 11:15, 11:30, all of a sudden, 11:30 to 11:45, things change. The market breaks down. The door was open for 366.60. They went to 366.60, slightly beyond, making a low of 366.03, but quickly turning around and going right back to where? Right back to the pivot cited early this morning, 367.95. What did they do? They ran a test of 366.60. Now let's look at it from a different perspective. Here is an hourly chart. Now we have a situation where the market makes one of these classic bullish, flaggish kind of patterns. There's your flagpole, even though I meant to use a different tool, still looks like a pole nonetheless. And here is your flag waving in the wind. So I can make the flag as thick as I want, but the point is, that's the major pattern when you look at the hourly chart. Okay, fair enough. Now, if they stayed in the upper range, it's really a bull flag pattern. If they come down, it creates or can morph into a bullish wedgish pattern. Either way, it's the same result. They have a move up, they eat some time off the clock for a while, building some energy for a secondary move higher. We also call these ABC patterns. How does that work? We have a move A higher, wrong tool again. After the move up, we have a secondary move or a move downward. That would be B, so I changed the tool, obviously. And then the C leg completes as long as they get over the high of the A leg. So this is very similar. You have a move up, you have a B, which is a pullback, but a shallow pullback is even more bullish because it's telling you that price isn't really getting rejected away from this area. It's just building energy, eating time off the clock, waiting for that time that it's going to make that secondary or another leg higher. They ran a test of that 366.60 yesterday, bounced off of it, spiked it through today, yet still bounced off of it. So if they get below and close below, we start to question the viability of this pattern. It's morphing into more of a wedge, and we don't know how far the wedge could come down. It's not really the same type of cleanliness to the pattern that we like to see, as long as they stay in, say, the upper 20, 25, 30% of this move. So you have a move higher. Let's say they stay in the upper 25 or 30%. That's telling you that they're going to have that secondary move in the upward direction. So we're moving along in the notes, and we post the chart, and it was the same hypothesized chart that we were just discussing. It was before the end of the day, so what you can see here is it was just as the hourly candle closed, and I know you can't see it in this video, but you can see an hourly tail candle and what morphed back into the same bullish flaggish pattern it was, so we call that running a test. They ran a test of an important spot. The test was a successful test because they got right back above it. They closed back above it. They got back above some other stuff. So we call that a test. So same operating concept of a bullish, flaggish type of formation in the making. That's what we're saying inside the numbers. That's what the tour guide is saying. By the way, does light volume, quiet markets, lack of volatility support higher prices or lower prices into the holidays? The answer is it supports higher prices, or at minimum of sideways, generally speaking, sideways to higher. Light volume, there's no sellers around. It's easy to goose the market. They like to goose the market into and around the holidays. Who is they? Well, it's part of the Trick, Trap, Fool, and Frustrate crew. They have a subcategory called the Goosers. These are the same people that also show up in the last few minutes of the day when they goose the market up into the closing bell. We also call that an end-of-day jam session. Now, as the afternoon goes on, the market gets really quiet, so I like to teach some stuff. I like to lay things out. You have the schematic on both sides of the coin, and you can certainly go ahead and pause the video and read the rest of the notes for yourself. I urge you to do that. Read the notes, go back to the charts to see exactly what happened. As we go out into the end of the day, things were getting quiet. We'll go down and take a look at inside the numbers, and we will take a look at two stocks. One is PM, and it says jump target on the entry hit column on the right, but there were two numbers, so we got the second one. We'll take a look at that chart. The other one we'll take a look at as KMX. In fact, let's look at that one first. So KMX did a little bit of a dance at the open. They came close to the price, maybe not close enough. This was one of those classic ones where here's a low of 95.64. My number was 95.02. They came somewhat close, bounced away. Was it close enough? Was it close enough to where we take the trade off the table? It was one of those questionable ones, and here's what I answer traders when they ask. If you think it was too close, then it was, scratch it off the table. This one could have went either way. So it blew through the first number, it went down to the second number. You see what happened down here. However, what really happened down here is they came up a couple of pennies short. The low here was 93.04, and they did the thing off of the next price or the next candle. They went all the way back up to 94. That's at least doing the deal off the second number, but they never did the second number. Then when they came back down, it was obviously already there, and then they just traded in and around that price down at 93 for the rest of the trading day, back and forth, traded below it, traded back above it, closed below it. CarMax, as a trade opportunity, it just didn't work. The numbers were off, the trade was off, it didn't work. We're not giving it a classification as a shitburger, it just didn't work. This is another good, learnable opportunity, teachable moment. Philip Morris, getting a haircut at the open, and the price is hovering above the first number at 82.76 for quite a while. We get closer to the opening bell, and price drops below, and it opens below the number. What do we do with that? We wipe it off the board. That number doesn't exist. It's a no trade. What do? We look to the second price. There's a reason there's a second price. It's another viable number, 81.78. So here they come. Within a half hour of the trading day, they're coming into the number. And you see what happens next. It takes them a little while to turn the battleship. Philip Morris, a big company, big stock, took a little while to turn around. What did they do? They turned it around from the second price. And what did they do? They went right back up to where? Yep, you got it, the first price. What was the high in this candle? 82.74, 2 pennies below. Are there any accidents or coincidences in the marketplace? And the simple answer is no way. See if this one makes sense. The stock is hovering above 82.76 in the pre-market. By the opening bell, they opened below the number, telling you there's something else they're after. There's a different destination. At least that's the way I look at it. That's what it tells me. All right, fair enough. They go down to the second destination. They bounce back up to the first destination, come up 2 pennies short. Is the first destination resistance now, what I thought would be support if they opened above it? And the answer is absolutely. Once below, a support level becomes resistance. Once above, a resistance level becomes support. That's the way the market works. That's why I don't call them support and resistance numbers. I call them important numbers because you don't know whether they're going to be support or resistance until price is above or below. Welcome to my world. Welcome inside my head. How about a 120-minute chart? So let's look at it from this perspective. Looks like an hourly chart, only compressed, but here's what we have. Remember that up move that we talked about? We talked about the flagpole on the hourly chart. Well, we don't have to draw that one. We have a flagpole on the 120-minute chart. So here's what we have. We have a bull flag pattern in the making. They ran some tests down below, but they never ran a test of what? Of the breakup candle low. Where is that? Guess what? It's at 364.60. We'll call it 365 down to 364.60. So here's what I'm saying. Even if they drop the market, let's say that happened on Wednesday, and you woke up and you found by the opening bell the spider was down right around 365, 364 and a half, maybe even a touch below. Are they going to fight that price to close a 2-hour candle back above the break-up candle low? And the answer is, under normal garden variety conditions, the answer is yes. So what I'm giving you here is something to watch out for if in fact they drop price down to that 365 or below price level. So here's what it looks like, or here's the way I think about it. Here's the way you might want to think about it. It's up to you. So right here we have a bullish flaggish pattern. Let's say they started to come down toward that 365 level. Traders would think that the market is failing. It would think that the market is coming down, and what was once bullish yesterday, and I'm going into tomorrow, right? So you're looking back to yesterday, you're saying, hey, it was a bullish pattern yesterday, now it's not so bullish. You take a look at a short time frame, it looks terrible. You take a look at an hourly chart, it looks terrible. But you take a look at a 120-minute chart, and maybe, just maybe, they would be running a test of a breakup candle low. If a successful test, what would they do? They would go back in the other direction, and they would have shaken everybody out of a long trade, and then what would they do? They would rally him into Christmas. I'm not saying that's going to happen. I'm just saying that's an awareness that you have to write down on a sticky note and see if it begins to materialize. If that begins to materialize, you'll remember where you heard it first. Boy, was that a bag of wind. What's going on over in Camp IWM? Pushing on the old highs from a couple of days ago, uptrend. Obviously, they're getting extended from home base at this point. We don't like to get too far away from home base. When they do, markets will come back toward home base or go sideways, eat time off the clock, letting home base get a chance to catch up to price. What's going on other than that in the IWM? It's bullish, the trend is up, and there is no change. While the IWM is my favorite market leading indicator, and the folks down at the transportation department, they're number 2. However, they are the number 1 canary in the coal mine. We still have divergences working in the transports. So we have a bearish pattern working on the daily chart. What this tells me is that if in fact this pattern plays out in full, it's probably going to wind up somewhere in the vicinity of the 50-period moving average down around 12,100, give or take. Maybe it played out yesterday from a symmetrical standpoint. Maybe it's got more to go. Maybe it's a rolling top. We don't know yet, but what we do know is this. Here's how we're going to gauge it. Above the 20-period moving average should probably get a repair job underway because the trend is your friend. Staying below the 20-period moving average, and there's some question marks ahead on whether or not this market can sustain itself or fall off further. 12,715. If they can't close a day or multiple days above that price, then there's no dice. Now that's slightly above the 20-period moving average, but that's a secret number. What about the folks out in Silicon Valley? What's going on over here? Same routine, bullish, above, all the moving averages, the trend is your friend, all that stuff. No change in the Qs. What about change in the XLF? Maybe the XLF is telling us something. Could be a canary, we don't know, we'll see. Down 1%, they gave up the 20-period moving average today. Now, they've been riding the 20-period moving average. They give up any more of the 20-period moving average, meaning another day, they come down further, and we talked about the price. Here's the low, 28.11. You don't want to see closing below that low. That opens the door for other stuff. Doesn't mean they have to fall. It opens the door for other stuff. Fill the gap over here, and if there's any acceleration on the downside, and if the major markets or the other indices are selling, you'll see more selling in the financials as well. If they're just going back and forth, eating time off the clock, and they're going to make a move higher, what's the target? And we know from the weekly chart, the target is what? Say it after me, $30. When you look at the weekly chart, what are they doing? They're doing nothing other than just hanging around, going back and forth, not getting rejected away from this area, but seems to be, and under garden variety market conditions using the 80-20 rule, what they are doing up here above all these moving averages is just eating time off the clock, building energy to do what? Run a test of the big breakdown candle high. What's the price of the big breakdown candle high? $30. Smash mouth down a little bit. Smash mouth riding the 20-period moving average. If smash mouth gives up the 20-period moving average, there could be trouble in the tech sector. Smash mouth is a pretty good proxy for the tech space, not necessarily the same as the transports are for the major markets. However, on a micro scale, it's a fractal, right? Everything is a fractal of something else. So this would be a fractal of the larger canary in the coal mine, if you will. So if the SMH is going to have trouble, it's generally signaling that the tech sector is going to have trouble going forward. So we're watching, as long as they're above all the moving averages, there's no trouble in paradise. If they give up the 20, there's trouble in paradise. If they give up the 20, there's probably a pretty quick shot down to about 208.5. If it's a hard sell, if there's any velocity for some unforeseen black swan kind of thing over the holidays, tomorrow, the next day, whatever, if that does happen, 201. 201 is a buy area for a minimum of intraday support, if not more, like multi-day support. Have I told you how much I appreciate each and every one of you? Without you, these videos are not possible. That is true and accurate information. We're going to pull the ripcord here today. I'm David Frost, my strategic forecast. Thanks again for tuning in to another episode of Common Sense Market Analysis.